Hello, my name's Mark, and you're watching or listening to Resource Talks. Today, I'm pleased to be joined by Michael Howell, who is the CEO of Crossborder Capital, a London-based fund management firm. Michael has a doctorate in economics, and he's worked in financial markets since 1981. He developed a research methodology during his time at Salomon Brothers in the 1980s, which he continues to champion to this day. His approach is unapologetically quantitative and squarely focused on the role of liquidity in driving market cycles. This year, Michael's erudite analysis of liquidity cycles has led him to a number of counterintuitive and bullish conclusions about the direction of asset markets. Before we hear from Michael, though, please remember that he cannot give you, a stranger watching online, personal financial advice, and clearly nor can I. So please do your own research before taking any decisions with your money. With that said, Michael, thanks for coming on the show.
Great, Mark. Good to be here.
Michael, I'd like to start by getting your big picture view. So if we were standing on a mountaintop together, overlooking the global economy, what would we see?
I think we'd see, first of all, the beginnings of a liquidity cycle that bottomed last October 22, and is likely rising to a peak, which may occur sometime around late 2025, early 2026, that sort of time frame. It won't be a straight line up. These cycles never are, but I think the key point is that investors, both in stocks, general financial assets, and ultimately commodities, will now face the wind behind them rather than the wind in front of them. That was really the story of much of last year and maybe a bit of the year before. So I think there's a definitive change in the cycle. Now, liquidity is a leading indicator. I'll define maybe a little bit better what liquidity is in a moment, but it's a leading indicator. It leads economies. It doesn't follow economies. And as liquidity is now rising, you'd expect signs of stabilization beginning to occur in the world economy. Now, I think if you're taking a commodity or resource slant, which you clearly are, within that mix, one needs to look at who are the key drivers of commodity markets. And what it really comes down to, I guess, is sort of two big players. One of those is obviously the Federal Reserve. The Federal Reserve controls the denomination of commodity markets, in other words, the US dollar and what's happening to the dollar. And the other is who creates the demand for commodities in many ways, and that's China. So one's got to look very closely at the People's Bank of China. So it's more than Fed watching. It's Fed watching and PBOC watching. But more generally, we think of the whole pool of liquidity, and we monitor what we call the global liquidity cycle.
So you talked about liquidity being the fundamental driver of markets. But hasn't the Federal Reserve been doing quantitative tightening? In other words, allowing treasuries to roll off its balance sheet? And doesn't that involve liquidity being sucked out of the system? So how can you be bullish in that backdrop?
Well, I mean, the answer is a very good question, and clearly that's the policy, that's the obvious or headline policy that they're following. They're saying that they're basically doing QT, quantitative tightening. They're shrinking the balance sheet. They're not really saying they're taking liquidity out of the system, and I would argue they're no longer doing that. The risk of doing that is that if you take enough liquidity out, you'll create financial market tremors, you'll trigger bank crises or whatever. And after all, didn't we just get that with the failure of CSFB, SVB Bank, etc.? Those are really problems that the financial system encounters through low liquidity. And basically what we're arguing is that that's now behind us. The Federal Reserve is actually beginning to add liquidity, and it's doing those through different channels. And the mistake that I think a lot of analysts make is to look at the published balance sheet of the Federal Reserve and not to make appropriate adjustments, because all items on the Fed balance sheet are not liquidity creating. Some are not liquidity creating or liquidity destroying, I should say. Some of those will have different effects. And basically what you've got is, let's say, a left-hand side of the balance sheet, the asset side, Fed assets, which has generally been increasing, despite the fact that you've had a roll-off of treasuries, as you rightly say, in terms of their security holdings. And the reason for that is that primary credit, in other words, discount window borrowing by banks has jumped, and also support through something called the Bank Term Funding Program has also increased Fed credit. So there are items that are directly offset the roll-off of treasuries. On the other side of the ledger, if you look at basically what else is happening, there have been two items that have also influenced things. One of them is called the Treasury General Account, which is basically the Treasury's float at the Federal Reserve. That has fluctuated. It was drawn down significantly during the period of the debt ceiling in the US. That adds liquidity to markets, and now it's being rebuilt, and it should detract from liquidity. It would do, bar from the fact that the other item on the liability side, the reverse repo account, has started to drop precipitously. The reverse repo account drained 2.5 trillion of liquidity out of the market at its peak, and it's now falling fast. It's about 1.7 trillion, and that drop of about 1.7 or about 1.7, 1.8 trillion has basically been has occurred over the last 6 months or so. So what you've got is a significant injection of liquidity going to the system. The fall from 2.5 trillion to 1.7 is very meaningful.
And at what point then did this situation change and liquidity start increasing? Does that correspond with the movement that we've seen in equity markets upwards this year? Or was it prior to that?
Yeah, I mean, the answer is that basically the cathartic change was the British gilt crisis in September of 2022. Now, that may have been a blip on most people's radar screens. In other words, it was an event, but it wasn't a particularly deleterious event. Our point is that had that occurred in the US Treasury market, there would have been another 2008 type crash. In other words, this was a big event for a major bond market. It so happens that the UK gilt market's not that important anymore. The US Treasury market is. And I think that was a wake-up call to policymakers worldwide, particularly the US Treasury officials, to say, look, we've got to be very careful here, because sovereign bond markets are really the main plank, if you like, of stability in the financial system. And if you start to see wobbles in those major sovereign bond markets, then we've got big trouble. And the reason for that is that since the 2008 crisis, most lending in markets has been collateral based, and the collateral that is used for borrowings basically are sovereign bonds, particularly US Treasuries or German bonds. These are critical items, securities. If they fall in value, then you've got an immediate threat of a credit crunch. So there's a sort of doom loop involved in this whole process, which means that central banks and policymakers have got to be a lot more alert to what goes on. So I think that what you've got to start looking at is a very broader view of who operates or controls financial markets. It's not just the central banks, it's also the treasuries as well. And in terms of what the treasuries are doing, the profile of their issuance and the timing of their issuance is very important in terms of market stability. Now, let me just give you two quick heads up about that. One of those is that the US Treasury at the moment is increasing issuance, but it's focusing very much on the short-term bill market, not on the coupon market, in other words, Treasury notes or bonds. So in other words, everything is going through at a maturity below 12 months, or a large part of that, big significant increase in bill issuance. Now, that is basically raiding money market funds, or the balances that money market funds had in the reverse repo facility at the Fed. So they're basically using money that was, if you like, sterile on the sidelines to fund government activity. And that clearly is not draining liquidity from the overall system. Arguably, maybe it's actually boosting it. So what you've got is a situation where actions of the Treasury are important. Another thing that's occurring is that the Treasury is slated to do Treasury buybacks next year. Now, we don't know what form that will take exactly, but broadly speaking, what they'll endeavour to do is to buy in stale, old, long maturity treasuries, off-the-run treasuries, as they're called in bond speak, and they'll basically issue new on-the-run treasuries at a shorter maturity. Now, one of the things that will do will be to, A, reduce duration in the market, which is like a liquidity boost. And the other thing that they'll do, the other thing that does, is it makes the market more liquid, because effectively a new on-the-run treasury tends to trade at a higher price than an old treasury. So you've actually got better liquidity in the system. The Treasury in the US is doing that. So what you've got is effectively the Fed and the Treasury acting together. And what I would say, sort of as a last comment, this is a bit of an extended answer, but as a last comment, look, if the Treasury is doing this, it's focusing its issuance, or it's targeting its issuance on the money market funds. It's talking about Treasury buybacks. It's clearly concerned about liquidity in the system. And that tells me they do not want to pull it down. They don't want another SVB. They want to end the regional bank crisis. They don't want to stir it up. So that is really the flaw in the system, if you like, the flaw as in FLOOR, the flaw in the system that we're looking at. And, we've reached that flaw. Markets are moving up on the back of that. The first trigger was the UK gilt crisis. The second was the SVB crisis.
So do you think that in some events, do you think that in some sense, the British gilt debacle in October 2022, as well as the Silicon Valley bank problems later on, were like cracks appearing in the system that sort of signaled red lines then beyond which central banks cannot go without triggering more widespread crises?
Yes, I think that's right. I mean, I think what we've got to recognize is we live in a fragile financial world where it needs constant care from monetary authorities and treasury departments. I mean, they basically need to look after the system. They need to manage it. And the reason for that goes back to, if you like, errant policy in the last 20 years, which was keeping interest rates way too low for way too long. And what we've done as a result of that is to build up this huge debt mountain. Now, the point that we make, and the reason that the financial system is so vulnerable, and it needs central banks and it needs QE, is simply that this huge pool of debt, this $350 trillion that we've amassed, has to be rolled over. The thing about debt is it has a fixed maturity. So if you've got an average maturity of that 350 trillion of, let's say, 5 years, that means by simple maths that you've got to roll over 70 trillion a year. Now, that's a huge or eye-watering amount of debt to refinance. And to refinance, you need balance sheet capacity in the financial sector. Balance sheet capacity is all about liquidity. And the liquidity measures that we talk about when we talk about global liquidity, what we're really talking about is this balance sheet space, if you like, the capacity on the financial sector balance sheet to actually take on the debt role. And what drives that is ultimately central banks and the pool of collateral that's available to borrow against. So if you want an idea of, what risk there is in the system, what I would be looking at would be measures of what the Federal Reserve or other central banks are injecting in the system, and something which may be a bit of a wonkish concept to people, and that is the MOVE index, which is a measure of bond market volatility, so it's MOVE, and that is the equivalent in bond land of the VIX index for equities. Now, the point about that index is that if that index is very high, the haircuts that credit providers will give on collateral tend to go up. So in other words, in a volatile environment, you can't borrow so much against your collateral. If you've got a low volatility market, you can borrow a lot more. You can use that collateral more efficiently. And the point is that what we've been through in the last 6 months is sky high levels of bond volatility as a result of the UK gilt crisis and SVB, where the MOVE index hit 200 or exceeded 200. Now, to measure that properly, what you need to do is knock off a zero and say what that 200 represents is 20% annualized volatility in bond markets. That's a huge number. Okay, when I was trading or operating the fixed income markets, 150, in other words, 15% was considered end of the world stuff. So we've just surpassed that. What's happened since then is that the Treasury and Fed in the US together have brought that number right down to about 110 on the move index. So bond volatility has almost halved in the last 3 months. And that's a significant point because it's liquidity enhancing. So, what you've got is, I think, an environment which is getting better, not worse. Now, what we haven't done so far is to talk about the other big player, which is China. And China is material in this. And China has basically, become, if you like, the second major player in terms of world financial markets and liquidity. And it's done that really because China is now such a big economy. It's got a major economic footprint in the industrial world, and it's a huge user of commodities. Now, the People's Bank of China tends to have its biggest effect on the tempo of the Chinese economy. If the PBOC, the People's Bank, eases, you tend to get a direct impact on the Chinese economy pretty much immediately. I mean, it may take a few weeks, but it's pretty instantaneous. And if they start to ease, the Chinese economy jolts forward, etc. And if they tighten, it slows down. And therefore, their use of commodities tends to go up with that business cycle. Now, the Chinese have basically had, if you like, a stop-go policy or stop-go monetary operations over the course of the last 2 years. And that has been caused to a very large extent by the gyrations in the Chinese yuan. Now, if you recall what happened last year wasn't only about the COVID lockdowns in China. It was also that the Chinese yuan, the currency, was coming under huge pressure. Now, although this is a maverick view or a maverick or left field view by me, I think that there was a deliberate attempt to weaken the Chinese yen through a joint coordination of the US and Japan. And the Japanese yen, if you recall or listeners recall, in the spring of 2022, began to weaken substantially. The rate of decline in the yen versus the dollar, which basically ultimately hit 150, but it started off around the 110 area. That weakening in the yen was the most dramatic that I've ever seen in a major currency. So much so that I would venture that markets could never do that. Only governments could do that. I mean, the scale of the drop was eye-wateringly fast. Now, that put a lot of pressure on the Chinese yuan because clearly Japan is a major competitor economy or collaborative economy in the region. And there was a lot of pressure which then transferred on the yen, on the Korean won, and then ultimately onto the Chinese yuan. And the Chinese were forced to tighten monetary policy to basically hold the yuan below the critical 7 level against the US dollar. They ultimately were forced to let it go. And once they let it go, they started to ease monetary conditions very aggressively. And that was one of the things that caused the upward jolt in the Chinese economy and maybe the mini booming commodity markets around the turn of this year. What's happened since then is that you will recall in the last few weeks, there's been another renewed bout of yen weakness. There's been another element of yuan weakness. And as a result, the Chinese have been forced to tighten monetary policy again. This is latest read as of mid-July. Now, interestingly, coincidentally, all that occurred just ahead of Yellen's visit to Beijing. And my view would be, again, a maverick view, is that what's going on here is there's been pressure put on China to do some sort of sous la table deal or create a quid pro quo for saying we will, being the Americans, will take pressure off the Chinese yuan if China agrees to continue purchasing US treasuries. They need to get China on board because there's an awful lot of treasuries to sell here. And that may have been the deal. We'll never know. But the markets are responding since Yellen's return to the US pretty much according to this script. The dollar's weakened, the yuan, some of the pressures come off the yuan, etc. So it may be that what's going on here is there is an attempt to weaken the dollar by the US authorities. And that accords very much with our view, which basically is saying 2022 was all about getting the Federal Reserve balance sheet down and the dollar up. and 2023 is all about getting the dollar down and the effective balance sheet, in other words, the liquidity creating parts of the balance sheet up. And that's what's going on. So what we suspect is the dollar is going to continue to weaken. It's not going to be very weak. I mean, this is an adjustment, we think, of maybe 5 to 10% within a long-term upward bull market in the dollar. But we do think there's a meaningful correction coming, and that will be clearly positive for commodity markets. Not least, it may give the Chinese a window to ease again, and that will again be positive. So these are the factors that we're really looking at. But the bottom line is that the general global liquidity cycle is going up. It bottomed last October. It will peak in 2026.
Right. So you're alleging that there could possibly have been some sort of financial blackmail against the Chinese so that they continue buying US treasuries.
Could well be. I mean, stranger things have happened.
Yeah, you could write a novel about that. It sounds pretty shady.
Well, I don't know. I mean, I think that's what there's a lot of let's say currency arranged deals done, or arrangements in the forex markets, and I think you've got to be alert to the fact that there are certain lines drawn in the sand. Central banks don't like currencies in free fall, and that's clearly a factor. But just go back to the period of the yen weakness, and think of what the US reaction was to that yen weakness. Japan being one of America's biggest trading partners, and America having called out Vietnam, a minor player, for manipulating the Vietnamese dong only about 12 or 15 months prior to that, they said absolutely nothing when the yen weakened. Now that's strange. They didn't call Japan a currency manipulator then, and they're certainly not calling Japan a currency manipulator now, which is very odd in the context of their previous stance.
Talking of Japan, I wanted to bring that country up because it seems to me that, you correct me if I'm wrong, which I'm sure I am, it seems like it contrasts a little bit, with your view about liquidity being the primary driver of equity markets, because they've had no shortage of accommodative monetary policy and liquidity pumped into the market, but the Nikkei 225 has gone basically nowhere for decades. So how do we explain that from the perspective of liquidity cycles?
Well, I think the answer is it can be rationalized quite well. I mean, the fact is that central banks are not the only source of liquidity. There are other entities in the system. I mean, one is, obviously the banking system is a key player, and cross-border flows from foreign investors. Now, I think if you look at all those factors, you've got number one, that the BOJ it's not been a one-way street in terms of the BOJ printing money, although that is the common narrative or the popular narrative, and it's unquestionably true that the BOJ has been buying lots of JGBs, Japanese government bonds, that's for sure. But just because they expand the balance sheet by buying JGBs, Japanese bonds, in a similar way to the fact that the Fed does a roll-off, it doesn't tell you everything about liquidity. And what the Japanese were doing last year was sterilizing a lot of those, more than sterilizing those purchases. And actually, Japanese liquidity fell last year, despite a lot of buying of JGBs, because they offset that through other elements of the balance sheet, one of those being a buildup of the Japanese equivalent of the Treasury General Account. So they basically absorb liquidity from the markets in that pool. The second thing is that if you look at the Japanese banks, they are not the force they were in the market. Their lending behavior has been constrained because they've had balance sheet problems. And then if you look at what foreign investors are doing, or foreign investors are not doing, they have not been investing in Japan until recently. Now, the flurry of interest in the Japanese stock market this year has coincided with a BOJ that's basically been expanding liquidity, pari passu, in fact, with the rise in the market. So the two have gone together, and foreign interest has come in. What you haven't had yet is a lot of domestic buying by Japanese institutions. And if Japan is going through a period, or entering an era, I should say, where inflation is likely to be higher than many people can remember in Japan, and maybe that's still low by Western standards, but by Japanese history, recent history, inflation at 2-3% is hyperinflation in their context. people are going to start taking money out of bank deposits and postal savings, and they're going to be putting them into stocks or other inflation hedges. So I think you can see a significant move of money into the Japanese stock market. And I think, Japan, in our view, looks a very interesting place to be for the first time in many, many years.
And obviously you have this focus in which liquidity is the central driving component. But how do you factor in the role of productivity and fundamentals into your modeling? Because if economic growth remains lethargic, that should show up in companies' earnings, no? And surely the stock market can't go up for long if the E component of the PE ratio is flat or even falling.
Well, yes. I mean, I'll come quietly on that, but I think there are caveats that one needs to draw. The traditional model that people look at, as you say, when you're looking at stock markets, is to say you've got an E which represents earnings, and you've got a P multiple that multiplies those earnings, and that's how you get a stock price. Now, that model works very satisfactorily at the individual company level, and I've got no quibble with that. That's value investing, or whatever one likes to call that, and that's a pretty good discipline. Doesn't work at the macro level, okay? And the reason it doesn't work at the macro level is that the PE multiple fluctuates hugely all over the place, okay? Now, the question to ask, therefore, is not so much what the E is doing, is actually what the PE is doing. And the PE is driven by two factors, principally. One of those is the flow of liquidity, because if you have more liquidity going into a market, then you're going to get PE multiples expanding. And if there's less liquidity, the PE multiple will come down. And the second thing is that what really matters for asset allocation, really beyond anything else, is inflation. Now, there is a secondary factor that tends to come in, which is demographics. And, over the course of the last 30 years, the world has benefited from aging demographics, whereby people want to hold more financial assets in their wealth portfolios. Okay, that's fair enough, but that tends to be a trend factor. The other element is the inflation backdrop. And if you take we do this research and we've published this research, so it's fully available. But this is a challenge for people that are interested. Take a look at the data that is on the Robert Shiller website. This is the Yale University professor who provides lots of data on long-term financial and economic trends. And he has on there 3 data series. One is a measure of cyclically adjusted PE multiples. Another is the long-term bond yield in the US stock market. And a third is underlying inflation. And if you look at what correlates with the PE multiple, it is inflation and not the bond yield. Now, that's not what the textbooks tell us, okay? The textbooks tell us it's all about interest rates, and it's all about looking at bond markets, and bond markets will shift equities around because there's institutions doing an arbitrage. That was true for a very small window. It was true from the middle of the 1970s to maybe the mid to late 1990s. That has not been true before that, nor since that. And one of the things that people keep saying is that bonds and equities have broken apart. They lack correlation. Well, actually, in reality, they only had correlation between 1975 and 1999, say. And in that period, that's when most financial analysis has been done, coincidentally. So all the studies that you read have been done in that particular window. If you take a much longer time horizon, and even look at the more recent data and weigh it more heavily, you'll find that actually what really matters is inflation. Now, that's important because there's been a very recent debate in the media, Viz, for example, in the Financial Times in the last two weeks or so, which has said, isn't it mysterious that the stock market's gone up? Because all these things, what we've been fearing about, recession, earnings crashing, high PEs, they've not really come to pass. So maybe the reason that the market's gone up is a lack of negatives. And that's really been the debate. Okay, you haven't had a recession, you haven't had bad earnings, you haven't, no one's worried about high valuations or whatever. Actually, the reality is it's not because of lack of negatives, it's because of 2 big positives. Number 1, inflation has come down, and number 2, liquidity has gone up. It's as simple as that. And that's our simple view of the world, maybe. But what we're saying is that it's always the same. If inflation starts to come down, investors will pay a higher price for earnings. The PE multiple will go up. And if liquidity goes up, they'll pay even more. So what you've got is earnings have been actually relatively benign, one would say so far, and the PE multiples have gone up.
But sort of dragging you back down to the micro level, because I mean, really, the macro is just a composite of all the things that happen at the micro level. No, won't it kind of be difficult for PE ratios to be reinflated while interest rates are now around 5%? Because, you know, in a discounted value model, the value of profits in the future, the type promised by, you know, growth stocks, now needs to be discounted by the greater opportunity cost of tying up that money over time, you know, namely forgoing the chance to earn 5% risk free. So isn't it quite hard to arrive at the same kinds of stock valuations that we had, you know, during the pandemic bubble with interest rates of 5%?
Well, the answer is that let me answer that maybe in two ways. I mean, one is to say that, you know, I'm a firm believer in the fact that interest rates have to be high, policy rates, that is, because I think we've got to get out of this debt problem. And the only way to disincentivize people taking debt is to have high interest rates. But I mean, it's a little bit like a sort of Goldilocks idea that you can't have interest rates too low and you can't have interest rates too high. If they're too low, you encourage debt. If you have them too high, you create funding problems, particularly for the fiscal authorities, who basically have got to pay an increasing interest bill. So you've got to have them high enough, but just right. So I think we're going to have elevated interest rates for some time. That's not really the question. But I think to come back to your point about a dividend discount model, that's clearly a textbook model that fits exactly into the frame that I've just criticized, which basically says these models were devised during the 1970s and 80s and whatever, 90s, and they worked very well during that period, but they didn't work outside of that. And if you want a sort of a technical or quasi-academic answer as to why, it's because the risk premium that's in those implicitly in those models is highly volatile. And basically what happens is that it tends to fluctuate because of inflation and because of liquidity. And so what I would argue is in a rising liquidity environment and in a falling inflation environment, that risk premium tends to be narrowed significantly. So, okay, you've got a constraint. I'll come quietly and say you've got a constraint if interest rates are high, sure. But the other factor that's driving the market is risk premium and implicitly what's going on with inflation and liquidity. But don't take my word for it. You know, go and look at the data. The Robert Shiller data is there in black and white on his website. You can do people could do the calculations as easily as I can.
Well, I wouldn't be so sure about that. I don't think I could do them. Talking of interest rate rises, though, do you think that they're yet to manifest in the real economy? Because, you know, after the Silicon Valley Bank collapse, there was a lot of talk about how financial institutions were seeing big black holes opening up in their balance sheets. In other words, that they're experiencing mark-to-market losses on their bond holdings. Is that an ongoing threat to bank solvency and liquidity if interest rates stay where they are or are raised higher?
Well, there's a risk if interest rates go up, yes, because then you've got the risk of losses on bonds. If they stay where they are, there's not a problem so much. But the bank term funding program means that basically, in extremis, if the bank wants to put the bond or the security back to the Federal Reserve at par, they can do that. So in other words, they've sort of taken out the mark-to-market element of the problem. Now, I think if you then sort of come back and think, you know, more about have we reached a peak in interest rates, which I think is a meaningful question to ask, I would say we're at or very near the peak. And I think if you look at the US, notwithstanding the fact that the consensus is now 100% that the Federal Reserve is going to raise interest rates again, my view is it's kind of difficult to do that. They may get away with it. I think they're going to be really hard pushed to do more. And the reason being is that, you know, it comes back to this concern about liquidity. And if they start to raise interest rates again now meaningfully, then what you've got is a problem for for the money market funds that are using this reverse repo facility. Now, this may be, again, a wonkish argument, but the point being is that the reverse repo is an overnight facility. And if and the bill market tends to be targeted at 3-month or 6-month tenors. That's what the Treasury will do for the money funds. Now, if you've got a regime where interest rates are going up, broadly speaking, what you're doing is disincentivizing people putting money into the bill market. And you're saying, well, okay, why don't you stick in this uncertain environment? Why don't you stick with overnight rates? And so that would cause money to flow back into the reverse repo facility, which would then cause a liquidity crunch in the system and would feed back onto the regional banks. And that's what I think they don't want to do. So I think they've got their hands tied to a large extent now anyway with rates. Now, the other point that is worth pondering is whether the economy is interest rate sensitive anymore. And I think this is again a sort of puzzle where, economists have not really helped out very much because, in many ways they need to understand that the economy has moved on from the textbook model or the standard model. And, what is it that's really interest rate sensitive in the components of spending? You've got aging demographics, which means that household formation rates in a lot of economies are low, and therefore people are not buying consumer durables, and therefore interest rates don't matter that much in that context. Secondly, there's not very much capital spending, or if there is capital spending, it's sort of grant aided by fiscal authorities trying to satisfy a green agenda, and interest rates don't really matter in that context. And then you've got working capital, but then working capital is not particularly stretched at the moment, not particularly high. So again, maybe that's not an issue. So what I would say is that maybe the interest rate sensitivity of the entire economy has dropped. And, notwithstanding looking at it in an even simpler way, we've got a lot more service industry and a lot less manufacturing. So why shouldn't that be true? After all, if you go back to the period prior to the global financial crisis, when interest rates were held at near zero levels for a long time, and actually they've been held since the global financial crisis at very low levels again, we haven't had that positive on the economy anyway, have we? I mean, the low interest rates didn't help boost growth very much. So why should high interest rates negate that? So I think the fact is that the economy is not that interest rate sensitive. Inflation is definitively coming down because there is a squeeze. Maybe the Federal Reserve has been successful in manipulating inflation expectations, but you've got to remember that a large part of that rise in prices was cost related, and cost pressures tend to be self-regulating, self-righting. That's the nature of economics. The part of the inflation that's not self-correcting is monetary inflation, which is what the monetary authorities create. They're trying to row back on that, but I would argue that financial stability concerns really prevent that.
Clearly, one ceiling on rising interest rates is the massive debt burden that governments have, and during COVID, government's deficit spent by issuing debt that was then monetized by central banks. Do you think that this is something that can continue to happen, or is that just a surefire path to hyperinflation and the death of money? Or are you sort of in some kind of monetarist, this neo-monetarist school that doesn't think that's going to happen? Or
well, I think it can happen. I think it will happen, and I think the reality is that there's no alternative. And the interesting watershed that we passed was that in the COVID crisis, this is the first major economical fiscal shock where there's been no tax increase. All the 100% of the increase in government spending was paid for either directly through the debt markets or indirectly via the central banks. Now, this is a path forward. So, our view is that if you take the last 6 months, for example, to put this in sort of maybe stark headline terms, is that central banks have spent the last 6 months bailing out banks. They're going to spend the next few years bailing out governments. And the reality is that aging demographics and over promises by politicians have basically loaded the dice with lots of mandatory spending. So the mandatory spending that is demanded now or required in terms of government and what government dishes out, the mandatory element is this huge, it's eye-watering. It's getting worse and worse. You can see that if you just look at the Congressional Budget Office data for the US. Now, I'm not singling out the US because the US is the cleanest shirt in the laundry here. All the other countries are in a terrible situation, okay? But it so happens that the US is actually very upfront with its data, and you can see it in black and white. But broadly, you've got deficits of 2 trillion to fund each year on top of the rollover of existing debt. So this is a huge, huge problem. And the question is, who's going to buy that debt? So you've really got 3 options as far as I can see. You've got foreigners, okay? Foreigners in the case of the US, and the US is in a pretty luxurious situation because it's a high figure, basically sell about a third of their debt to foreigners, okay? Well, you know, I've covered the China aspect, but you've also got the Middle East, and you've got Japan, and you've got Britain, who tend to be big buyers of US Treasury debt. But if China decides to go slow on that, there's a problem. And I think it's a big ask to assume that foreigners are going to take up US debt in the future if there are questions about the integrity of US fiscal finances, okay? The second thing is that you could get the domestic private sector to buy. The problem with that is that the domestic private sector may want to buy, but they'll only do that at higher interest rates. Now, if you start to charge higher interest rates on your debt, you're going to start to balloon the interest bill, and you're going to require even more debt to actually fund that. So you're on a dangerous knife edge. I mean, Japan, where interest rates are radically lower than the US, is now spending almost 25% of government spending, current spending, on interest payments, okay? And that's at a low interest rate. Just think if rates are, you know, where they are now in the US. And bear in mind that the US is issuing bills here, not coupon bonds, and the yield curve is anyway, you know, pretty flat. So what you've got is a very high interest bill coming up for the US, which it needs to keep refreshing because these bills are basically up to 12 months. There's got to be another round of refinancing this stuff in 12 months' time. Now, those are 2 main sources, and they seem to be gonged out. So you're left with a third, which is the Federal Reserve. So the Federal Reserve's coming back. Actually, pick up a copy of the Congressional Budget Office projections to 2033, and you'll see a line there which says Federal Reserve buying, and it's going up. So it's there. I mean, it's policy. More QE is coming. And that's monetary inflation.
So you said that you foresee the next bout of QE being to bail out governments rather than banks. But is that possible without destroying the currency? And on a related note, what do you make of these rumors of the BRICS nations devising a commodity-backed currency in order to rival the dollar? Is it possible for the dollar to lose its reserve currency status, or is that just a fairy tale?
Well, okay, let me answer those 2 questions separately, okay? I mean, I'll give you a taste of that. It's a fairy tale at the moment, but I'll come back to that. If you come back to the question about, is this going to destroy the value of the currency, and is there, you know, is there a lot of monetization going on? I think it's a question of degree. I mean, it's like saying, you know, thinking of you know, somebody who likes drinking alcohol. Okay, well, maybe if you drink you know, 3 bottles of wine a week, you're okay. If you drink 3 bottles of wine a day, you've got a problem. Okay, so it's a question of extent. Can we trust politicians to keep you know, fiscal spending in order? You know, big ask, but you know, maybe we're not going to the hyperinflation example yet, at least. But clearly, you've got to watch that. There's a temptation there. And if you look at the projections that we've made, and we've looked at the CBO numbers, and we've actually adjusted them because we think that some items like defense are too conservative, and we've refreshed those numbers with bigger ones, and we come up with a figure that would suggest that the Federal Reserve balance sheet is growing at a figure of about 10 to 12% per annum over the medium term, annually over the medium term. So, you know, that's quite a lot. If you'd said that directly reflects monetary growth, and there's a lot of monetary inflation out there, and you could say, well, okay, doesn't that mean, you know, high single figures inflation? Well, it may well do, okay? You can't translate monetary inflation directly into high street inflation, but it's not a bad heads up, okay? So that's the risk. And I think the US authorities, by dint of what I was suggesting in the case of Yellen's visit to China, if this has been done, are thinking in those terms to say we don't want to rely on the Federal Reserve too much to bail out governments, okay? But it may be happening. I mean, this is clearly a concern, which is why we say to our investors, what you've got to start looking at is inflation hedges. You've got to look at things like precious metals. You've got to look at resources generally. You've got to look at equities, not bonds, and you've got to start thinking about cryptocurrencies. All these things fit into standard inflation hedges. Maybe residential real estate, not a bad. It's always been a pretty good inflation hedge as well. But you don't want fixed income. That's what generally underperforms in this environment. Now, come back to the dollar. I think the dollar fits into this picture again by, let me use that quote again, where it's the cleanest shirt in the laundry. I think gold will go up, so I think the dollar will devalue against gold, and it will devalue against precious metals. But I think among paper units, the dollar still remains king. And the reason for that is that it's true what you say, that the BRIC economies and others want to basically create a substitute for the dollar, and they're thinking of various schemes. They may be building up their gold reserves. They may be doing building a stable coin equivalent, if you like, among those countries. But the reality is that, you know, what we're in, as I call it, is still Bretton Woods 1, despite the fact that people come up with these names like Bretton Woods 2, Bretton Woods 3. It's not the case. Okay, we've never left Bretton Woods 1. What was Bretton Woods 1 about? It was about the centrality of the dollar in the international financial system. It was about basically the IMF and the World Bank policing imbalances, and it was about the US military underpinning the world trade structure. Okay, all those boxes are still ticked. That's what we got. Okay, the one thing we haven't got is, or maybe the two things we haven't got, is fixed exchange rates and capital controls, which were actually part of the original Bretton Woods deal. They've been gone. In actual fact, the two coincide, because you can't have fixed exchange rates with very volatile capital flows. So once they started to deregulate capital flows, currencies had to float. But floating currencies were not the mainspring of Bretton Woods. The main element was basically dollar centrality, and that's what we've got. Now, the question to ask is, okay, if you want to replace the dollar, and let's say it's China, which does it, the Chinese yuan becomes the new dollar. The question to ask is, can China act as banker to the world? And the answer to that is simply no. And what you require for that is that basically the US acts as a kind of a shock absorber. So if the world wants to increase its savings, the US financial markets open their doors and they accommodate people that want to save money in dollars, US treasuries, US stocks, whatever. And when the world wants to borrow dollars, US banks lend. Now, there's no other country which is strong enough and has deep enough financial markets to do that. And the misreading that you still get from a number of economists is to say the US trade deficit, the whopping trade deficit that America has had and was getting again, is a sign of the lack of competitiveness of US industry. That's absolute nonsense. It's a sign of the super competitiveness of US finance. It's as simple as that, because the two must balance. You have to have, if you like, the financial surplus and the trade deficit matching, because that's what the balance of payments does. It balances. So that's the reality. And unless you get China building up its financial sector hugely, which I'm saying is not impossible, but it certainly isn't going to take place in the next 20 years. Okay, you're not going to go. It will take you time to do that. China is hooked on the dollar. Okay, and in fact, the great paradox is that since the 2008 crisis, China has become actually more integrated into the dollar zone, not less. And this is the problem that China's got. Hence, it's been relatively straightforward, if you like, for America to launch a tax on the Chinese yuan.
Right. Talking about the competitiveness, though, of the US, I mean, that narrative that someone like Trump came with of hollowing out of the US industry and the Rust Belt and the deindustrialization, I mean, that came after the Bretton Woods Agreement, no?
Well, I don't think so. That came out of the World Trade Agreement in 2001. And that was basically letting China in And when you say that that's a sign of a lack of competitiveness, it's actually it's a sign of Chinese unfair competitiveness. I mean, the fact is that China, as we know, were cheating in a lot of areas. They were stealing American technology and whatever it may be, and dumping goods. And, China may well have been a currency manipulator in that sense by not allowing the yuan to change as it should have done. But, the whole sort of modus operandi of US policy there, which may well, with hindsight, have been very blind and very naive, is that they basically thought that by opening up or integrating with China and opening up trade to China and encouraging economic development, they'd basically win on the human rights front. And that was what a lot of the agenda of both Clinton and Obama was all about. It was basically about the human rights record and trying to, understandably do that. But the problem was that in economic terms, China basically muscled in and took a lot of American markets. And the loss of jobs that you're seeing, or you've seen in the US and in Europe as a result of that unfair competition, is what has encouraged populist politicians like Trump to come forward. But, Trump's analysis of the problem is correct. Whether his solutions are correct is a completely different question. But I think his analysis is right on.
Mm-hmm. Well, let's exit this history lesson of Bretton Woods and the World Trade Organization and move back to the present day, because analysts have been almost unanimous in their predictions of doom and gloom going into 2023. But you, on the other hand, bucked that trend, and so far your minority bullish view seems to have won out. How long, though, do you think that broad market indices could keep rising? You said until 2025, is that right?
No, I think to be precise, what I said was I think the global liquidity cycle is likely to peak around late 2025, early 2026, and that's a projection based on normal cyclical developments, and that's what I would envision is likely to happen. Okay, that's my best guess at the moment. Markets never go in straight lines. We've got to remember that. And there will be hiccups en route. There's no question. But the fact is that we've now got a situation where, if you come back to my argument that, what really matters for financial markets is rising liquidity and falling inflation, we've basically got one of those boxes ticked, which is liquidity should be rising. There may be a hiccup en route, but broadly, that's the direction we're going. So the other part of the equation is to say, what's going to happen to the inflation outlook? Is inflation going to come down? Is it going to go up? Now, that's something which we kind of touched on, but my view would be that we're in an environment where inflation could be volatile now. I mean, I would fully expect that the underlying level of inflation in Western economies is probably higher than what we've seen in the last 20 years, okay? Now, to judge that, what you've got are two elements in there. You've got two elements in high street inflation. One is cost inflation or cost deflation, and the other is monetary inflation. Central banks create monetary inflation. The private sector creates cost inflation or deflation, okay? And it mostly creates cost deflation. And one of the biggest sources of cost deflation in the last 20 years has been China. Now, if you roll forward, what I would argue is that in terms of the cost element, we've had a big surge of costs because of COVID, and that cost element is unwinding now. And you're going to see, probably negative impact from that cost inflation on high street prices. So in other words, we're likely to see inflation pressures in the high street come right down and maybe even touch deflation on a monthly basis. That's quite possible, okay? But that will be short-lived in terms of the cycle. The monetary element, I think, is continuing to build up in the medium term for the reasons I gave, because central banks are going to have to buy more and more government debt, and that's the reality. So that monetization will create a monetary inflation that one needs to protect against, but some of it will spill over into the high street. Now, the wild card there, which will add to volatility, is what does China do in the medium term? Now, my view, and I may be, again, completely wrong about this, is that I don't believe in the deglobalization story, and I don't believe in, the decoupling argument from China. I just think it's impossible, okay? I mean, these economies are too integrated now. already, world economy and China are too integrated, and that's not how capitalism works. Okay, I mean, this would be a strange world if we deglobalized right now, because basically capital wants to seek out opportunities, and there are a lot of opportunities in China. So I think there'll be some accord between the two sides, and whether that is, as it is now being mooted, de-risking, whatever that means, but it means your selective best technology is probably not transferred in some way, shape, or form. But I think, if the West has got concerns about this, I'm sure China's got equal concerns on the other side. But China is dominant in a lot of spheres. Metal processing, key metal processing in one of those, and I think the West basically needs to have more of a dialogue and more integration with China. So let's say these economies remain integrated. Okay, that will still raise a number of issues, and one of those is who controls available resources. So there will be a scramble for resources, I think, in the world. And that will put upward pressure on resource prices because, China will say that's our sphere of influence. America will say that's our sphere of influence, etc. So I think there'll be, attempts to secure resources. And that was very much the case in the late 1930s. If you looked at the interwar period, there was a scramble for resources. And I think that will happen again. And, I think the other thing that is going on is that you'll start to get China wanting to compete at the medium value added area. Okay, so China maybe can't compete now at the top end because America's restricted technology, but they may want to compete in the middle bit. Now that will mean having a competitive exchange rate. Now, or it means, in economic parlance, if I can turn to that, having a competitive real exchange rate. Now, if you think of the real exchange rate, which is a concept that economists think of, it's basically your nominal exchange rate times a price level. Now, that price level could be export prices, it could be a price like wages, but think of it in those terms. So if you said, well, okay, this technology shock, the limits on technology transfer mean that China has got to take an exchange rate hit of some form. And let's say that's a 20% or so fall. I'm conjuring up numbers here. But let's say that China deserves to have its real exchange rate locked by 20% because it needs to become competitive in this new area of the market, which is sort of lower to medium value added goods. So therefore, either the yuan has to devalue by 20%, or Chinese wages have to go down by 20%, or Chinese prices have to go down by 20%, or some combination of that. So this is just the argument. So what are you seeing now in China? You're seeing downward pressure on the yuan. You're seeing big downward pressure on their capital markets in terms of asset prices, and you're seeing prices going back into deflation. So what I'm saying is that the real exchange rates are already adjusting. Now, that could well end, mainly because governments don't like prices going down. They prefer to see exchange rates weakening, if anything, because that's the more comfortable adjustment. What that might mean, therefore, is the yuan continues to weaken. And I would suggest that what you're likely to see is maybe a yuan with a 10 in front of it against the dollar, not a 7. Now, that's not going to happen overnight, but come back in 5 years, and I reckon that's where it's going to be. So if that's the case, what you're going to get, because Chinese goods are going to be radically cheaper on one of these other routes, is effectively you're going to get another deflationary surge in the West. And that comes back to the idea that what you've got is a period of volatile inflation. And that's got to be factored into financial market investment. And if inflation, when it picks up, PE multiples will come down. And when inflation drops back again, PE multiples go up. So what's really driving, I would say, stock markets and asset markets, risk asset markets, in the next 5 years is going to be the inflation cycle rather more perhaps than the liquidity cycle, because I think the liquidity cycle is going up. It's trending more.
And how do sort of more qualitative elements though fit into your model? Because if you look at the S&P 500 index, but an equal weighted version of it, that's basically been flat this year, and all the gains seem to have been concentrated in those big tech names like Apple, Alphabet, Microsoft, and especially Nvidia. So is it not plausible that had Chat GPT not been released earlier this year, and there hadn't been all this excitement over AI, that we wouldn't have gotten the current rally, and in which case maybe it really has nothing to do with liquidity at all.
Well, okay, then why is the DAX index up in Germany? Why is the Japanese stock market up? I mean, these are
Fair
assets from
argument.
America,
Fair
but
argument.
they've
Yeah.
also gone up. And I think that,
Okay.
if you wanted to justify the parts of the US market that have risen, I think you could say that these are the sort of counters that would go up in an environment with lots of liquidity and falling inflation, which is long duration investments. And that's what they
Right.
are, after all. But, if you look at the sectors of the US market, I think I'm correct in saying that the two strongest sectors are house building and semiconductors. House building is not high tech. It's cyclicals, and cyclicals have clearly outperformed defensives. And I come back and say to our clients, look, you've got to remember here, just forget what maybe a lot of economists are saying. Think about the Stanley Druckenmiller index, which is Druckenmiller used to say that the best economist I've got, and he was, the star US investor of the last 20 years, Druckenmiller would say that the best economic forecaster is the internals of the stock market. So what he used to look at was the performance of cyclicals against defensive names. And you look at that ratio, it mirrors the economy. And what's happened so far this year, cyclicals have radically outperformed defensives. It's telling you the economy is turning.
And do you do fundamental analysis as well, or is it just enough to allocate by asset class based on your reading of the liquidity cycles?
Well, we don't drill down to the individual stock level. No, we don't do any of that. What we tend to look at is we look at currencies, we look at fixed income, we look at equities, we look at it by equity market, by geography. So we look at Europe, America, etc., Asia. And we might get into sectors, but that, in terms of broad sectors, cyclicals, defensives, and we look at precious metals, etc. So we do all that. But then, as I say, if you look at the commodity markets, it's really about, as I sort of said at the beginning, currency, the dollar, and what the Chinese economy is doing.
Right. And when it comes to industrial commodities, do you just look at that as a big category, or would you have, a certain metal that you prefer, maybe copper or steel or nickel, based on other narratives like the greening of the global economy, factors like that? Do you take that into account?
Well, I'll come quietly and say that, maybe, if I listen to those same narratives, copper sounds to be the choice metal. But we're not commodity experts.
No.
Liquidity, we look at liquidity.
So talking about liquidity and the liquidity cycle, where do we need to be in that cycle for it to make sense for you to go into industrial commodities?
Well, normally you'd like to see a lot more momentum in the liquidity cycle, to be absolutely sure, because commodities. As far as I recall, there are sort of two phases in the commodity cycle. One's a restocking phase, and the other is basically when commodities are used much more as an inflation hedge later in the cycle. Now, from what I'm saying is that inflation hedge may be a trend feature now, because I think there's going to be a lot more sort of structural inflation in the system for reasons I said about governments having to be bailed out. So you may want more commodities anyway as an investment. And that was, after all, the lesson of the 1970s. But in terms of the cycle, I think that you would expect to see, if we're correct, and the Chinese economy begins to turn around with more stimulus in the next 6 months, then you're likely to see commodity markets picking up in the near term as that restocking cycle begins.
And that would similarly apply to energy like uranium or oil or natural gas?
Should do, yeah.
Right. Okay. Michael, it's been really interesting to get the benefit of your decades of research and experience. Before we wrap up, is there anything that I didn't ask you about that you'd like to mention?
I don't think so, really. I think that, the two things to remember in terms of our very simple philosophy of financial markets is you've got to look at liquidity and you've got to understand inflation. And that's what it's really about. Inflation governs asset allocation between tangible and financial assets. And liquidity is really just saying whether your portfolio is generally going up or going down.
Right, well, it's great to hear some positivity because that's been sorely lacking. Well, at the beginning of the year, it was more people are coming out to your side of the argument now. Though, and where can listeners go to follow your work?
Okay, we've got probably three or four sources. There's a Substack site called Capital Wars. Capital Wars is named after a book I wrote about 3 years ago, or 3 or 4 years ago, called Capital Wars, all about global liquidity. So that's the Substack. We've got a Twitter handle, which is Crossborder Cap, at Crossborder Cap, which is sort of frequently updated. There's a LinkedIn site, and the website is crossbordercapital.com.
Michael, thanks again for coming on the show.
Great pleasure, Mark. Thank you.
Excellent.